Thanks to all of you for giving me the opportunity to speak with you. In our remarks this morning, I'm going to start with an overview of the university budget, then discuss the impact of the COVID pandemic on our financials, and I'll explain what general funds are and why they're important to the budget. I'll then turn it over to Jamie, who will discuss the university's financial governance and the endowment before we open it up for questions. Next slide. So the university budget overall is about $7 billion. I think the magnitude of that often surprises people in terms of what a large, complex enterprise Stanford is. If you think about the core university activities being educating students, undertaking research, and delivering healthcare, the revenues from these three activities combined generate about 57% of our revenue. Student income includes undergraduate and graduate tuition, room and board. It often surprises people that even though education is the most central part of our mission, student income comprises only 14% of our revenue. Sponsored research revenue is the funding we get through research grants and contracts from the federal government, corporations, and private foundations. It also includes funding for the SLAC National Accelerator Laboratory, which is a national lab that Stanford manages on behalf of the Department of Energy. With respect to healthcare services, Stanford Healthcare and Lucile Packard Children's Hospital are separate nonprofit corporations that function as subsidiaries of the university. Their combined revenues are also about $7 billion, and that's not included in the pie chart. However, most of the hospitals are school of medicine faculty, and the healthcare services revenue represented here are the funds transferred from the hospitals to the university to pay for those physician services and other support provided to the hospitals from the university. Expendable gifts comprise about 6% of revenue, and investment income is really two parts. About 20 of the 23% is the annual payout from the endowment to support university operations, and 3% is the income generated from investing our expendable funds or working capital. You know, if you look at investment income and gifts combined are 29% of revenue, and compare that to student income and sponsored research, which combined are 38% of revenue, you can start to get a sense of the degree to which philanthropy subsidizes these core activities. In effect, close to half of the funding for education and research comes from endowment payout and annual gifts. The other bucket includes a wide range of activities such as executive education, conferences, athletics, arts revenue, patent licensing, and just a host of other things as well. Next slide. Our largest expense by far is compensation and benefits for faculty and staff. And then you can see the other kinds of expense that make up the rest of our expenditures. Next slide. So this slide shows our actual financial results for fiscal year 2019, our projected results for fiscal year 2020, which just ended August 31st, and our budget for fiscal year 21, which is the year that just started. I'll use this table to explain the impacts of COVID-19 on our budget. If you look at the total revenues line in the middle of the page, you'll see that revenues are expected to decrease in 2020 and again in 2021. This is very unusual. Historically, our revenues have been growing about 5 to 6% a year. So in the aggregate, the fact that we have a decline these 2 years is entirely driven by the impacts of the pandemic. If you look at the student income line, what we incurred in fiscal 2020, particularly in the spring and summer quarters, was the loss of room and board revenue. Of course, we sent students home in the middle of winter quarter. We rebated room and board for the balance of that quarter. And then we had no room and board revenue in effect for the spring. And then in the summer, we suspended all of our traditional programs. So we had not only no summer tuition revenue, but no room and board revenue as well. When we built the fiscal 21 budget, and that was done back in June, at that time we assumed half the undergraduates would be on campus, so we expected pretty much full tuition. Of course, now that we know that we have very few undergraduates on campus in the fall, our actual student income revenue for 21 will be less than what was anticipated. But part of the increase also represents the opening of Escondido Village graduate residences, so there's a boost in room and board income as a result of that. Research, as you'll see, is flat. There is increase in grants and contracts to the university, but part of what flows through the sponsored research revenue line is construction spending at SLAC, and that is moderating after very large capital expenditures over the last few years. Healthcare historically has been the fastest growing source of revenue at the university. It's grown about 10 to 12% a year compounded over the last decade. But in fiscal year 20, we had to shut down all elective procedures beginning in March, and that extended on through May and June. And even today, although it's largely come back to normal levels, that did have a big impact on the fiscal 20 projected outcome. In 2021, we're assuming that there will be pretty much full resumption of healthcare activities with the revenue flowing from the hospitals back to the university. In terms of investment income, fiscal year 21 reflects the decision to reduce payout on non-student aid funds by 10%, as well as I mentioned earlier that line includes payout on our expendable funds or working capital. At the time we built the budget, we expected that the returns on the merged pool, our major investment fund for 2020, would be minimal. And the way the payout on our expendable funds worked, we assumed no payout in 2021. So that's a shortfall of about $200 million. What's actually happened, the returns on the merged pool were much stronger in 2020 than we anticipated. Of course, you're all aware of the summer bull market that I think exceeded everyone's expectations. So I think looking forward, 2021, we will actually do better on the investment income line than what was built into the budget. In terms of other revenues, there was a huge impact on executive education, which basically shut down in the spring and summer. As I mentioned earlier, we have no summer sessions, so no conferences over the summer. So that's why you see other income down both in 2020, and that's continuing through 2021 as well. On the expense side, the compensation line historically has been growing about 6% a year due to a combination of both headcount growth and higher compensation. The very low growth that's projected in 2021 reflects the fact that we both had a salary freeze, no salary increases for 2021, and the impacts of the layoffs that we did in August and the very tight budget situation. In the other expense category, not surprisingly, spending on travel and the cost of hosting conferences, food and entertainment expenses, all of those things are down significantly. So that's, we're seeing savings on that. The bottom line, which in our parlance is reflected as the change in fund balances. The budget's really built on a cash basis, not on a GAAP accounting basis. So you can see that change in fund balances are projected to be negative in both 2020 and 2021. I'd say I have not seen negative actual results in all of my 20 years at Stanford. So this is a significant change from normal as an impact of the pandemic. Next slide. So what are general funds and why are they important? So most of the funds, about 75% of all the revenues in the university are restricted or designated for specific purposes. And as an example of that, 90% of the endowments that we have, the endowment funds, are restricted for scholarships, fellowships, professorships, support of specific parts of Stanford. Almost all of the expendable gifts we receive each year are restricted to particular purposes. When we get money for grants and contracts, we can only spend most of that grant money on specific purposes of the grant. So general funds represents roughly the 25% of our revenue that is unrestricted and can be used for any purpose. And we have a slew of different core university expenses that are really dependent on these general funds for support. For example, while we are very blessed having a number of endowed faculty chairs, we don't have enough to cover all of the faculty, and quite a lot of faculty salaries are supported by general funds. You know, all of the building, maintenance, utilities, operating expenses are supported by general funds. Most of the administrative staff is supported by that as well. A lot of our debt service and even financial aid. At the undergraduate level, about a third of undergraduate financial aid is dependent on general funds, 2/3 really coming from endowed scholarships and annual giving. Next slide. So where do general funds come from? About half of general funds come from tuition. Tuition is unrestricted revenue. And that's really a major reason why the decision on how much to grow tuition each year is so challenging for the university. It's a critical source of funding to cover so many expenses that cannot be paid for in any other way. About a quarter of the general funds comes from the payout on the unrestricted part of our endowment and expendable funds. So people often ask, why don't you spend more of the unrestricted endowment to pay for either athletics so that we don't have to cut the 11 sports, to pay for more people so that we don't have to do the layoffs and so on and so forth. And the answer is, if we take capital out of the endowment and reduce it, we would really lose the ongoing payout from that part of the endowment that supports general funds, and general funds would be even more pressed than it is today. And on the right side of this chart, you can see that general funds has declined as a share of the budget, which has left us less and less flexibility over time in managing the overall budget. So now I will turn it over to Jamie to cover the university budget from a trustee's perspective.
Jamie, we need you to unmute yourself.
Thanks, Randy. Who decides what at Stanford Finance? Let's talk budget, tuition, and endowment. This is Stanford's organization chart, at least from a finance view. And you might notice that there are many people involved in finance, and they don't report to a single CFO as they would at a business or at some other universities. It's more complicated because decision-making at Stanford is more decentralized than at other universities. For example, if a faculty member has an idea for a program, they can, with permission, approach donors to get endowed or expendable funding, and for the most part, that faculty member is in control of those dollars. That can make Stanford unwieldy to manage because, unlike a company's CEO, President Tessier Levine and Provost Drell can't just tell the faculty what to do or redirect those funds easily. It's a shared governance model. Think Stanford Band. President and provost are on the ladder with the baton, and most, but not all, the musicians are playing the same tune. But that's decentralized decision-making. It reflects Stanford's entrepreneurial culture. How did the financial decisions actually get made? Well, let's start with the annual budget. Provost Drell serves as the CBO, the Chief Budget Officer of the university. She decides how to allocate those general funds, the centrally controlled part of the university budget that Randy just talked about. She also approves capital projects and faculty positions. She is supported and advised by a budget group, which is a committee of faculty members and CFO, Randy. Tim Warner leads the budget process, which is a full year ground-up process involving 29 separate budget units. Decision on annual tuition is part of the budget process, and that is approved by the Board of Trustees. We discuss prior year increases, the economy, financial aid programs, and soft issues like public sentiment. And finally, there's the endowment. Well, the investment management of the endowment is done by Stanford Management Company. SMC is a division of Stanford with its own CEO, Rob Wallace, who reports to a separate SMC board, and those board members generally have experience in investments and related topics such as environmental, social, and governance issues. And as you can see from the chart, it helps to have a PhD in acronyms. The decision on endowment payout, which is the amount of dollars paid out of the endowment to support the annual budget, is recommended by the Stanford leadership, and it's approved by the Board of Trustees, generally in February, as the final piece of the annual budget puzzle. Stanford Hospital, which is HAC and Lucille Packard Children's Hospital, they have their own CEOs and their own budgeting process, but the hospital endowments are managed by SMC. And Randy sits on the board of both hospitals in order to coordinate with the president and the Board of Trustees with Stanford Medicine. So Stanford, as you can see, it operates more like a conglomerate with shared administration than a company with a single line of business. But you can be sure that all the people and boards involved are checking in with MTL and Provost Drell. And I can tell you from personal experience, they have their pulse and imprimatur on just about everything that goes on at the university. Well, how and when do we use our endowment? Well, at the end of 2019, the size of Stanford's endowment was $27.7 billion. Only Harvard and Yale are bigger among private universities, which is a testament to Stanford, since those colleges have a 200-year plus start. While $28 billion is a lot of money, it must last forever. The income from the endowment, as Randy just pointed out, and other gifts fund almost 30% of the university annual budget. Our endowment payout formula, like most endowments, is based on an assumed rate of long-term return, which in our case is 9% overall per year. So in round numbers, if our endowment's just under $30 billion and we're paying out 5.5% per year, that will generate funds of about $1.5 billion to fund the university. And a good portion, as Randy mentioned, is used to fund Stanford's faculty and other significant expenses. But what if the value of the endowment declines? Well, if it declines, we'll pay out slightly more than 5.5% to cover Stanford's bills and financial aid. And in 2009 and 2010, during the Great Financial Recession, we did just that. We paid out over 7% and more to get the job done. Besides the payout of 5.5% per year of the endowment, there's an additional factor of 3.5%, and that covers merit increases, new programs, and inflation. And although inflation at the national level has been low, in the Bay Area, it's been high and rising. Housing affordability is especially an issue. The endowment returns over the long term, thanks to SMC, have been very good, among the best among large university endowments. It's actually been 10.7% since 1964. But as you can see from this chart, that hasn't always been the case due to bear markets. For the last 5 years, Stanford generated a 7.4% annualized net return, much better than the 5% median return for college endowments, but still below our 9% target. All of us know and we feel the uncertainty in the economy and the outlook for investments. And as Randy said, because of COVID and remote learning, there's even less predictability for Stanford's revenues and expenses for the next year or two. So after a lot of discussion, the leadership and board decided that the best and prudent course of action was to reduce the endowment payout from last year, but increase the payout for endowment related to financial aid. And in order to cover the deficit, which was caused by COVID and remote learning, we authorized withdrawal of $150 million from our quasi-endowment. We did this to protect financial aid and also to reflect our view that we might have to dig even deeper into the endowment in the next year or two, which we're prepared to do to support our students and faculty. This necessitated some painful budget cuts and staff reductions in the short term, but the university will be better positioned and stronger in the medium and long term as we evolve. That's a very abbreviated summary of how financial decisions are made at Stanford.